Hello, and welcome to Investment Insight, your clean take on the markets. Let's get started. Today we're diving into two really pivotal, and I mean structurally different investment stories that are defining this quarter. First up, we're tackling the, intense war brewing in the obesity drug market. We've got this sector with just unprecedented growth potential, but it's now colliding head-on with some serious government pricing risks.
Right. And then completely different gear. We pivot from that, highly speculative future of biotech to the rock-solid, old-school balance sheet of Berkshire Hathaway. We're tracking how the market is suddenly kind of reclassifying this giant, turning it into maybe the ultimate anti-AI safe haven.
Exactly. So our mission today, looking at the recent analysis, is really to cut through the noise, distill the core risks, and maybe spot the pure opportunity in these two, wildly divergent markets. We need to understand not just what's happening, but really why these political and economic forces are shaping things. Let's start, I think, where the money seems to be flowing fastest, the GLP-1 drug sector.
Okay, yeah. Let's unpack that high-stakes battle.
The drama around these next-gen weight loss meds, the GLP-1s, right, glucagon-like peptide-1 agonists, it's really reaching a fever pitch. And the first big thing defining this quarter, based on the data, was this intense bidding war over a company most people hadn't even heard of, Metsera.
Yeah, Metsera. And look, this wasn't just your standard corporate acquisition. It was, frankly, a desperate race for pole position in what could be a multi-hundred-billion-dollar market down the road.
Yeah.
You had Pfizer and Novo Nordisk, the two big players, locked in combat. In the end, Novo Nordisk got Metsera. But the price, wow.
That was the staggering part, right? $11 billion?
$11 billion, yeah. And what's interesting is the high estimate going in was maybe $10 billion?
So they went over that high water mark just to seal the deal. What does that extra billion really tell us? Is it just desperation?
Well, it speaks volumes, I think. It shows the perceived value of Metsera's specific technology and maybe Novo's fear of falling behind. Remember, Novo already leads with Wegovy, but the analysis suggests they were so motivated to get this specific tech, they saw that premium as, like, a necessary cost. And the immediate fallout. Pfizer is now seen as a significant latecomer. In a market defined by speed, that's not a good place to be.
Right. So let's get to the core of it. Why Metsera? Why $11 billion? What's the innovation they were selling that makes it such a game changer right now?
It really boils down to one word: convenience. To this pharma race, convenience is like the new currency. Think about the current leaders. Novo's Wegovy, Lilly's Zepbound. They both need a weekly shot. Self-administered.
Right, weekly. That's a commitment for potentially the rest of your life.
Exactly. It's a hurdle for sticking with it, for patient comfort, all of that.
So Metsera's approach is different.
That's the key. They're developing a drug that apparently only requires a monthly injection.
Ah, okay. From weekly to monthly.
Yeah. And that shift, just from weekly hassle to monthly ease, it has the potential to just flip the market structure. Think about it.
Yeah.
Better adherence, less lifestyle burden, and it could potentially draw in millions more customers who are maybe put off by that weekly needle.
Okay, so that convenience factor is huge. If you're watching this as an investor, you really have to follow the companies chasing that specific angle. The data mentions Amgen as being really aggressive here too, right?
Absolutely. Amgen is right there chasing this monthly format hard with their own injectable MariTide. They're deep in phase 3 trials now, targeting, I think, a 2027 launch. So this cluster of activity, it just confirms where the race is. Not just effectiveness, but making it easy, almost forgettable.
Okay, so we've got the explosive growth, the innovation pipeline, monthly shots. Now we have to talk about the elephant in the room, the massive threat. Because the future value of this whole sector seems to hinge entirely on, politics. Political negotiation, not just science.
Yeah, this is a big storm cloud gathering. The U.S. Centers for Medicare and Medicaid Services, CMS, they've started official price negotiations with both Eli Lilly and Novo Nordisk. This is the government using its huge purchasing power, and it's tied to getting these drugs covered under Medicare.
And the numbers being floated are, alarming seems like an understatement. What's the sort of worst-case number people are whispering about? That $150 demand?
That's the figure terrifying the street, yeah. CMS is reportedly demanding that the current monthly price, which is, around $400, $500, gets slashed way down to about $150.
Wow. That's, a two-thirds cut?
Roughly, yeah. A massive cut right off the top line.
So if the government actually manages to enforce that $150 price point, what does that do to the overall market size people were dreaming about?
Well, the most pessimistic analysis suggests The total addressable market, that TAM, it could shrink dramatically, maybe down to just one-third of what people were predicting. And here's the critical insight for investors, I think. The entry of new players, like Metsera and Amgen, it actually gives CMS more leverage.
Ah, because they can say there are alternatives coming.
Exactly. If the government knows there are multiple effective options on the way, they have more power to demand lower prices for covering any of them.
Okay, so navigating this, it sounds incredibly risky. The analysis talks about a two-engine strategy for the big players, Lilly and Novo. How does that shield an investor, sort of?
It's really key for mitigating that regulatory risk. Lilly and Novo, remember, they're huge diversified pharma companies. So while this GLP-1 risk is serious, they have other massive blockbuster drugs in their pipelines. These can help offset slower GLP-1 growth if that price floor really drops.
Like Lilly's Alzheimer's drug, donanemab.
Right, or Novo's established diabetes focus with Ozempic. They aren't just weight loss companies. That diversification provides a necessary cushion.
But what about the investor who is looking for that potentially exponential growth? The analysis suggests focusing purely on the game changers.
Yes, that's the high-risk, high-return play. Amgen, with MariTide getting closer, is definitely highlighted as a potent, maybe contrarian investment there. Investors should be looking for companies really solving that convenience puzzle. So the monthly shots, or, the absolute holy grail, would be a safe, effective pill you just take orally.
Right, the pill would be revolutionary.
Completely. But the main takeaway here is unavoidable. Investment returns in this sector, they're now subject to extreme volatility. And it's based almost entirely on how these CMS negotiations play out, not just the clinical trial results.
Okay. We spent a good chunk of time on the power of regulatory risk, specifically political forces shaping the GLP-1 market. Let's shift gears completely now. Let's look at a totally different kind of market force, the fundamental economic reality that seems to be driving Berkshire Hathaway.
Yeah, this is a fascinating story. It's about decoupling. For decades, BRK stock pretty much moved in line with the S&P 500. It was, the definition of steady, broad market exposure.
But the recent analysis points to this really clear, dramatic shift. It started around late October 2025. What happened was big tech stocks took a sharp dive. People worried about the huge cost of AI infrastructure, geopolitical risks hitting supply chains, but BRK stock actually rose over 2.5%.
Right. And the market's reading of that is pretty clear. BRK is now being treated as like an opposing force. It's become this new safe haven asset. It specifically hedges against the volatility you see in that whole AI rally. If you're getting nervous about tech space, BRK is looking like the place to park some cash.
And the Q3 earnings that came out in November, they really cemented this new identity, didn't they? Explain why it's seen as a refuge. What were the two core engines in those results?
Okay, so first you had the real economy check-in. Operating income from their core physical businesses, think BNSF Railway, utilities, insurance, it was actually kind of sluggish, which confirms BRK is deeply tied to the physical non-AI economy. Trains, power lines, businesses feeling the pinch from slower U.S. activity and those persistently high interest rates.
So it shows they're impacted by Fed policy, just like other traditional businesses.
Exactly. But that's only half the picture. The second engine, and this was the real highlight, was the cash cow aspect, interest income. Because the Fed has kept rates high for so long now, BRK's enormous cash pile, it's over $200 billion now. Well, it generated record amounts of interest revenue.
That's such a great contrast for people to understand. You've got big tech selling these, future dreams that need massive, maybe uncertain investment,
Right.
while BRK is making huge certain profits just by parking its mountain of cash in today's high-interest reality. How does that make it portfolio insurance?
Well, it makes it the perfect balance way. If your portfolio is heavily tilted towards big tech and AI growth, maybe you hold index funds like SPY or QQQ. BRK acts as this really strong, stable counterforce. If that perceived AI bubble were to burst, BRK acts almost like an anti-market force in that scenario, grinding out reliable returns from interest rates, not from tech speculation.
So investors really need to change how they think about BRK then. Stop seeing it just as a standard S&P 500 growth stock.
Absolutely. I think its identity has fundamentally shifted, or at least how the market perceives it has shifted. It's not really expected to dramatically outperform in a bull market anymore. It's become the ultimate value stock, and crucially, this incredible cash-generating machine. In this high-rate world, the stability and that huge interest income it throws off, it's almost like having a high dividend stock, or even a fixed income substitute in your portfolio.
This really highlights that idea of the K-shaped portfolio. I think that's a useful way for listeners to visualize what's happening.
Yeah, the analysis suggests the U.S. economy is clearly splitting. You've got that K-shape, the virtual economy, AI, big tech soaring up the top arm of the K. But the real economy, physical goods, infrastructure, core services, is struggling with high rates, dragging along the bottom arm of the K.
And a smart portfolio needs to kind of acknowledge that split, right?
Precisely. You want exposure to both. By holding both AI-driven growth and the stability of something like BRK, you're managing risks on both potential directions of that K. BRK isn't just a stock you buy for its management anymore. It's almost a structural component you need for risk management in this very polarized two-speed market we seem to be in.
Okay, so this deep dive really shows us two huge market segments being defined by these powerful external forces, political and economic. We saw the GLP-1 market, where future growth seems dictated by the political negotiating power of CMS. And then we saw BRK, where its whole safe haven status is pretty much defined by the interest rate policy set by the Federal Reserve.
Right, and that contrast brings us to, I think, a really interesting final thought for listeners.
Yeah.
Both of these huge, very different stories, the exciting GLP-1 drugs and the steady BRK, they both ultimately depend entirely on government actions or policies. One hinges on CMS negotiation leverage. The other hinges on the Fed keeping rates where they are.
So the question for you, the listener, is which of these forces, these political or regulatory forces, do you think holds more immediate power over market direction right now? Is it the Fed's interest rates driving BRK's massive revenue? Or is it Medicare's ability to negotiate drug prices, which will define the future, potentially, of that entire GLP-1 market? Something to think about as you position your portfolio. Don't forget to subscribe and hit that like button